Hello, YouTube. Hello, X. Welcome back to the channel. My name's Max. My channel's name is The Covered Caller. And tonight, it is time tonight and every night about this time, I have on my show called The Daily Factor. But before we get into the middle of The Daily Factor, we're going to look at Tesla high yield stocks, by the way, today. And we're going to have a surprise also. But before I get into that, let's look at the market and see what the market is doing. I've been concerned about the market, as you guys know, because I won't shut up about it. But especially Coinbase. So let me make that go away. Well, the daily bar, let's get a little bit more resolution, a little finer resolution here. Yep, that's what I was afraid of. That's a bad look for that's not a sign of a bull market. Even when we have a great rally like we did today and we're up, we got right to a logical place to sell and they came in and sold it. We need to reverse this trend of lower highs and lower lows. But we'll see. Every day's a new day. At least we haven't gone back and made a lower low tonight. That would be really bearish. And if God forbid, if we make a lower low on the other side of this green box, that's even more bearish. I'm not saying that'll happen, but that's the bearish case. The bullish case is that we make a higher low, then open up tomorrow morning and actually get on the other side of the moving averages. Maybe go up here and check this point of control at 95,000. That'd be a step in the right direction. And then maybe the next day we make another higher low, and go from there and either grind sideways for a few days or go up. But we have to stop the free fall. This is killing all these. A lot of these high yield funds are pretty much all crypto or crypto adjacent type stuff. So we really need that to go up. Let's look at S&P futures, and then we'll get in the middle of the daily factor. Let me see what this is doing. This thing wasn't even strong enough to make it back to its moving average. The bulls weren't even strong enough to. They weren't even strong enough to, this is just not good. This is weak. They weren't even strong enough. Here's the recent local low. They weren't even strong enough to close above the local low. And now they're trading back under the local low at 66.56. So, that's the first step for the bulls would be to take back 66.62 or whatever. And then after that, the next step would be to take back the moving average. We did it for a while back here. We had a big sell-off in late October and early November. The first week of November, we went straight down. But then we were able to mount a rally for a couple of days, even turn the moving averages around. The problem was we're also fighting this descending trend line. We got back close to the trend line and people took a chance to sell it. And they sold the heck out of it. They sold it from 6,900 all the way down here to where we sit at 66.34. Just not the sign of a healthy market. All right, so can't do anything about the market, though. We can do something about our allocations. We can adjust them to be more defensive or whatever. Jackson, what's going on, buddy? I've fed you like 4 times today. You can't be hungry. Jackson, you can't. There's no way you're hungry. This is the last time, Jackson. All right. Tesla Tuesday. Okay, so what is the max factor? Am I sharing the screen? I am sharing the screen. All right. So what is the max factor? The max factor is my own proprietary metric. It does a better job of looking at these funds than total return does. Sometimes you can have good total return on a fund, and it still might not be a great investment. It may be too volatile. It's usually too volatile. But you have to look at the risk-adjusted reward. The way I accomplish this is total return looks at NAV return and looks at yield, just throws it together. I look at those components separately. Everyone wants high yield, of course. And everyone wants high NAV return. So you can look at them separately and you can get a less myopic view. You can get it's a better statistic in my opinion. Anyway, we have these shows on every night. And then on the weekends, I have the top 20. But the reason I started doing this daily show is because the top 20 was the same 20 or 30 stocks every week. And so on these daily shows, we can really dive deep and we can check out all 150 stocks in the universe. All right, guys, thank you all for being here. Yeah, I know Jackson does want to eat. He does want to eat. All right, so let's do this. Let's get over to the graphic. I think I forgot to download that one. But we can talk diversified divas or whatever you guys want. Did I forget to download this one also? I thought I downloaded these things. All right, well, be that as it may, we'll start on Tesla Tuesday. Okay, so I always start with yield. Let's go yield chasing. So the highest yield is TSYY. So this is from Granite Shares. They sell put spreads, which is a similar thing to selling to doing a collar. So it's basically the ULTY strategy, but done with puts. ULTY does it with stock plus a call and a put. In any event, they do the ULTY strategy. So kind of similar to ULTY, they pay a giant yield, but they oftentimes have NAV issues. We'll see how, it pays a 39% yield. Of course, that has to deplete from somewhere. It depletes from the NAV. So let's check out the NAV. It actually hasn't been too bad. The past quarter, it's gone from 828 to 607. That's actually not too bad when you're paying 239% yield. But in any event, the rest of the story is Tesla's way up this quarter. Tesla, in fact, before we start, let's look and see. Let's look at Tesla this quarter. And we're just, or not Tesla, let's look at Tesla just this quarter and see what kind of performance we've had. And we'll compare with that TSYY since we just looked at that. So today is November 18th, 19th, something like that, 18th. And so we have to go back to what? August, September, October, November. Yeah. So we'll go back to August 18th. Wow, August 18th was a whole lifetime ago, and the market was doing great back then. That's when, that was a good time, unlike lately. All right, well, let's just look. I should do this every night. Let's look at Tesla's performance. So I think we can see why, a lot of these are doing really well. Well, heck, the parent asset is up from 335 to 408. That's 65 points on, or something like that, 75 points on 335. That's like 22%. That's really good. That's in a quarter. I mean, I guess I could look at it right here. Yeah, 22%. I did it in my head, I promise. I did it in my head, but I nailed that one. All right. So, that's now the high yield funds won't be at 22%. Their NAV darn sure won't be, because if you want maximum, return, you just buy Tesla. Don't mess with these high yield funds. They're a different instrument. You guys know that. All right. So let's get back here to the deal. All right. Then we have Tesla from YieldMax. 115% yield, and the NAV is down 15 cents. Think about that. The NAV's down 15 cents when Tesla's up. So that shows you what it takes for Tesla to have flat yield is in a quarter for Tesla to be up 22%. So, so if Tesla was up 50% in a quarter, Tesla's price would go up. If Tesla went up 200% this year and 200% next year and 200% the year after that, Tesla's price would recover. It's just math, but it would take an extreme move. All right. But to keep it flat, we need to be up 22% a quarter, just based on this small sample size. All right. Then we have TSLW. This is a good one from Roundhill. It uses a little bit of leverage. They don't even sell options. They sell total return swaps, but I think it's not a very important distinction. I bet you anything that their counterparty sells options to help offset some of their expenses, but maybe not. Anyway, TSLW, 56%. This thing's gone from 31.25 to 31.57. Now, but look, it pays about half the yield. So, we'd expect it to have better NAV. It's just math, because remember, the dividend depletes the NAV. So, really, it's kind of impressive that Tesla's doing really just eyeballing that right there. I'd rather have Tesla just eyeballing that right there. Both of them are basically flat NAV. One of them pays twice as much. So, Jackson, what are you doing? Okay, Jackson, just go lay down, please, buddy. You've ate like 5 times a day. He's had so much food. He doesn't like me on the internet. He doesn't understand who I'm talking to. All right. TS2, this thing's good. This thing's great from Rex. Only sells, they do the yield max strategy, but they only do it on half the portfolio. And look at the yield. They get about half the yield. But then they also kind of do the TSLW, the Roundhill strategy, because on the other half of the portfolio, they leverage just a little bit. So they're a good mix between yield max and Roundhill. I mean, their yield's the same now, and this is a better fund right here. This comparison makes Roundhill look bad because these guys are up $2. You know, I don't know why they didn't put the 1 year return. I mean, the quarter return on here. Anyway, whatever. It's not that big a deal. But anyway, it's up $2, which is about 10%. So it's 10% positive NAV with the, whereas Tesla and TSLW had flat NAV. TSLW paid the same. I'd definitely rather have TS2 and between TS2 and TSLY, I mean, you didn't get 10% NAV return, but you got double the yield. So, I mean, I don't know that TSLY doesn't look better to me right there, just amongst these. So then we have TSLP. Now, this is the most conservative of all of them. This one has the least NAV depletion because the depletion is just the yield. So this one only depletes 40% a year. So it's less pressure on its NAV. And sure enough, its NAV is up about $2, but from a lower price than this $2. And this one's up $2, $1.75, $1.81 actually. This one's up $1.81. This one right here is up like $2.50, $3, and it starts at a lower price. So if we did have the dividend or the NAV return, this would be like 15% or something. And of course, that makes sense because it has less NAV depletion. So that makes total sense. All right. Now let's look at the stable DEX. Which ones are the most stable? Now, none of them are that stable. And this is measuring how crazy the price moves up and down. And we compare it to the SPY, to the broader market, which is the SPY, the S&P 500. So this one, TSLP, is the stablest of all of them. And that makes sense because it also is the least risky by looking at the yield. And it's about a third as risky. TSYY, as far as price movement goes, isn't much more risky than TSLP. If you factor in the yield, it's risky, but this measures the price movement, how wild the price moves around. So anyway, TSLI is about 4 times as risky as the broader market. TS2 is even more risky than that. And TSLW is the most risky. All right. And sustainability is the new max factor. I used to call it the max factor. I need to change the title. It's the same thing. So the winner of the max factor, and it's got to be TS2, right? I mean, no cheating. Don't look over there. I mean, would you rather have something that's up 10% and pays 54% or something that's up 15% and pays 40%? It's probably close. And actually, TSLP is probably the winner because it's also more stable. It factors in the stability, and TSLP is pretty darn stable compared to the other ones. So what do we have? Yeah, TSLP, then TS2, then TSLW, then TSLY, then TSYY. All right. How did you guys like that? Did you guys like that one? All right. Let me see who's here. Make sure you guys are behaving. Hey, Bikerman. Hey, Chad. What's up? Yeah. Mr. was up today. I like to see it. Udar's here a bunch. You were here. Were you here for the morning show? I know you were here for the evening show. Bond's in the house. Thank you, Bond, for being here. No, I didn't see it. I have not. I've been going. I've not even had a chance to look. I went straight from my last show to make dinner, and then I rushed in here and barely got this ready in time. And no, I haven't. The thing I'm actually more concerned about is ULTI. I mean, just as far as because it's new and I'm trying to get a handle on it, and it's performing a lot worse than ULTY. So I really want to get a handle on ULTI, but I will of course look at what ULTY did as well. I mean, I want to look at all of them, K-yield, all of them, but the first one I'm going to try to do when I get off here is look at ULTI and see what they have. All right, let me make sure there's nothing else here urgent. All right, you guys are just talking about your trades. I'll look and see if you say max. If you say max, if it's something that needs my attention. Okay. All right, let's do the rest of this. I forgot to read my disclaimer. Be sure to remember this is not financial advice, fun and entertainment only. Consult a professional advisor. All right, so let's do the rest. So here's the surprise. If somebody, and it was probably one of you guys that was in here today, and I'm sorry if I forgot who it was. I think it was somebody kind of new. It wasn't Chad or Froggy or one of the old timers. I forget who it was, but somebody was just in love with either HOOW or GOW. Anyway, there's not a lot of Google and Hood. It's not a lot to compare it with. So what I did is I just thought, let's just throw all the Round Hill ones in, all the W's. Let's just see how those all do, because and because whichever one it was HOW or GOW, they're both in there. So let's just take a look at Round Hill and talk about Round Hill. I like Round Hill a lot. As you guys know, I have WPay myself. I think they do a good job. So here's the other caveat. I was literally since I signed off, we had a really long after market close one today. I don't know how long I talked, but I went straight from there into the kitchen, and then I cooked burgers. And I cleaned kind of half-ass. I need to go clean better. Then I ran in here and got this ready, but I have not had a chance to look at anything. So here's the caveat. On my Round Hill, I think there's some missing. I made sure that HOOW and GOW were in there, but they brought them out at different times. I brought this up, and I was like, gee, some of these came out recently. Like, I know they have to have been out a month. I know that the Costco one just came out last week or something. I mean, some of these, I think it did anyway. Anyway, I have some of the big ones, but I bet there's some of these ones that are 3 months old that I don't have on the sheet yet. Like Uber hasn't been around I don't think that one's old enough, but I have the main ones, and I need to add all the ones that need to be in there. But in any event, so this is probably a partial list, but it's what I have to look at. But I thought you guys would like it because I know I have a lot of Round Hill fans. And like I say, I like Round Hill a lot myself. Super happy with WPay. I'm super happy with the way it's been holding up, in the down market. So where is this darn thing? Well, maybe I didn't. I'll start it. I could have sworn I downloaded it. Okay, let's go yield chasing. Let's go yield chasing. 175 MSTW. Man, that's crazy. You want to talk about NAV depletion. I mean, 175% means it depletes more than 100% of its NAV every year. I mean, now it doesn't mean it's a bad investment necessarily, but it means it's going to be on the riskier side. And sure enough, and not only that, it also tracks Mr., which has been a mess lately outside of today. Anyway, so it's dropped from 37 to 16. It's bled off half its value in a quarter. But it's been a rough go of it for Mr. And I bet you it's down less than Mr. I guess let's go look at that. Let's go look at Mr. for the quarter. And then let's look at MSTW. Yeah, so the option writing hasn't given you much protection. But this isn't really option writing, it's leverage. So yeah, this catches, this one catches 100% of the downside. Something like YieldMax protects capital a lot better. It'll only catch like 80% of the downside because they actually sell options, and because they're YieldMax, the yield's a cushion on the downside. But anyway, this one's built for upside. It's not built for protecting downside, but that's neither here nor there. It's down 46%. The underline's down 46% on the quarter. Okay. So back here, I'm more worried about the downside. That's one reason I love I like yield max in lots of cases, but I like upside too. That's why you don't have to get just yield max. You don't have to get just round hill. You can get both of them. And you can also mix in some curve, and you can also mix in some granite shares. I mean, that's the beauty of it. Plus, I just like to stay diverse. All right, so that's the wrong thing. Where is this thing? Round hill. Okay. All right, so then we have HOW. So this is the one I think must have been that you guys were talking. No, GOW was the one we were talking about last night because it's just been on fire. Anyway, we'll get to GOW in a second. Okay, so this bleeds off 123% of its NAV due to depletion, just due to math. Doesn't make it a bad fund. It's just the numbers. But it follows Hood, so it matters what Robinhood's doing. I guess we have to do this for every one of them. But let's look at Hood this quarter, and let's look at HOW. Once again, this is going to probably catch 95, 100% of the downside, maybe a little bit more. Well, Hood's been all right. It peaked when Alti did, because it follows Bitcoin. But lately, because Bitcoin's in the dumper, so's this. But basically, Hood's flat on the quarter. It went way up and way down, but it's basically flat on the quarter. And sure enough, HOW, it looks like it roughly pretty much just matches it. Does a little bit better on the upside due to leverage. You can see it was leading on the upside. All right, so that's HOW. A lot of yield, though. Then we have PLTW. Okay, this pays an 80% yield. NAV's gone from 44 to 38. So, what's 44 to 38? That's actually not too bad. The NAV's down, 10, 15%, and it's paying an 80% yield? Heck yes. All day long. All day long. Great job, PLTW. But to be fair, I bet you Palantir's had a heck of a quarter. But I don't know. It maybe not recently, but let's see on the whole quarter. So Palantir looks like Hood. It's flat on the quarter. I mean, it started where it ended, basically. And PLTW is just tracking it. It was a little bit ahead on the way up. And yeah. All right. Well, now let's go to the next one. AMDW. Now, this thing's been on fire. Not so much lately, not the past week or two, but prior to that. So 63% yield, and the NAV went from 50 to 60. But now that's a dream come true. What's 50 to 60? That's 20% or 21.44%, I guess. You get 21.44% from the NAV alone. That's no dividend. And then you're cashing that kind of dividend check. Heck yes. Heck yes. But so let's see what you need to do. So think about this, though. AMDW's NAV was up 10%. So what is that? I bet you AMD's NAV was up, I don't know, over the same time, probably 50% or something. Let's go look. AMD's NAV went from 175 to 240. That's 65 points on, that's a third. Well, there it is right there. I keep doing it in my head. It's 36%. Okay. So it took a 36% face ripper for AMD to make 10% of NAV. Of course, you don't buy these for that's if you just want NAV, you just get AMD, right? You buy these because you get an income also. So that's, and the income is a tax on the upside, tax on the NAV. All right. So let's see what the next one is. TSLW, we looked at this last time. So we looked at Tesla and stuff, but NAV's flat. And Tesla I forget what Tesla was up. It was 22% or something. 22% gets you basically a flat NAV out of TSLW, pays 56%. I mean, that would work. GOOW. Now, this one's the monster. It's only paying 45%, but it's based on Tesla's volatility. That's the other reason. They say these total return swaps don't sell options. Okay, but they're still priced according to volatility. They still use IV in the formula. It's if they synthetically are selling options. And I'm telling you, the counterparty is selling options. I guarantee you to get the 45% to pay these guys. But then these guys could say, we don't sell options, you're total return swaps. I mean, but I bet you anything their counterparty's writing options. But in any event, but this isn't going to pay as much as a PLTW because the IV's much smaller. Google's a more established, bigger company, less volatile, whatever. So let's see what happened here. NAV went from 51 to 66. Oh yeah, that's the one we were talking about. That Google's up, 30%. Yeah, that's amazing. So what was Google up though? So for Google, if GOW is up 30%, what do you think Google's up? 60s? That's why for young guys, they just ought to buy Google and just stay away from these. Because you're always going to make more money. And if you're young, you have a job, what do you need income for? So let's see here. Google 203 to 280. So that's up 80. Oh, I keep doing that. 40%. So 40% from Google gets you, in total return, it gets you the same total return because the dividend counts too. But if, some people don't count the dividend, they just look at the NAV. But so that shows you get a 40% rise in GOW, and that translates to a NAV that's up 30%. That's pretty good though. That's really good. That's actually one of the best ones we've seen. This one's definitely going to win. I would think this one looks the best to me. This is the one I would take. I don't know. AMDW is tempting too because it's both. Either of them could work. Anyway, then NVDW. So this one, the NAV's actually down a little bit, but NVIDIA's not doing great lately. Down 11%, but it's paying the smallest yield. NVIDIA and Google are big companies that are more stable, so that does not surprise me. Let's look at the stable deck. Speaking of stable, which one's the most stable? GOOW is the most stable. And second most stable is NVDW. And that makes sense because they pay a lower yield. The yield also subtracts from the stability to some degree. Plus, a higher yield corresponds with a higher IV. Generally, higher IVs happen on stocks that go up and down more. Then we have TSLW. Boy, AMDW is almost as dangerous as the most dangerous one is MST, double leverage MicroStrategies. I think it has a 12, meaning it's 8 times as volatile as the SPY, as the market. 8 times as risky, meaning if the SPY is up 5%, MST might be up 40. Or if SPY's down, it might be down 40. I mean, that's crazy. AMDW has exhibited over the past quarter anyway, the same type of volatility. All right, so sustainability is going to be, yes, GOOW. So let's look at this and say, I don't know that I would rather have AMDW. But GOW, you have about a 15% higher yield, but or 20% higher yield, something like that. But you also have about a third less. It's close. You have about a third less NAV return. But the thing that tips in the favor is GOW is so much safer. It's like twice as safe. If you compare it to the SPY, it's like twice as safe, but it still makes enough yield versus the NAV return. It's the full package. AMDW could work also. TSLW, I mean, flat NAV and pays a 56%. That's not the worst, not the worst bet. But remember, to get that flat NAV, you need 22% up from Tesla in a quarter. All right, so that's it for that. Hope you guys like that. I hope your favorite funds were on there. We have all kinds of comments. All right, I'm going to try to go back and find the good ones. All right, Grumpy says he has TS2, TSLW, and TSLW too. Heck yeah. You just need to add to some TSLP. Heck yeah, TSLP is good. Yeah, I wish it was weekly. That's part of the genius of it. Lots of times the ones that don't pay weekly, it's because they sell monthly options. A monthly option just expires once a month, so they don't get the dividend in weekly. And even though they could probably do it and break it up and pay the dividends weekly, I don't think it's ideal. I think when you sell monthly options, you want to pay monthly income. But the thing is, selling monthly options is what makes them more stable. Selling monthly options doesn't cap you as hard as selling weekly options. And weekly options doesn't cap you as hard as selling daily options. All right, so you guys are talking to yourself. I'll try to not read the ones where it says somebody's name in it. All right. Today's your 1 year anniversary of being unemployed. Heck yeah, I'm sorry about that. Oh, you sold your small business on this date last year. Okay. All right, Grumpy. Yeah, Curve does a great job. I agree. Curve does a great job. And here's the trick. They use monthly options which caps the upside less. Part of what people call NAV erosion is the capped upside. The other part of what people call NAV erosion is actually NAV depletion, is a 90% payment coming out, is the NAV physically depleting. And how they solve that is they pay like about a third of the other companies. But yeah, they do a great job for sure. You will add anchor funds slowly and surely. Slowly diversifying. Diversification's a good thing. You're glad you're in K yield. Oh my gosh, you and me both. I mean, I was going to buy that. And I even told the manager, because I tried to buy it on Tasty Trade. Tasty Trade knew, because they wouldn't let me buy it. It was set to close only. And then I checked it the next day and it was set to close only. I'm so glad it was set to close only. Then I tweeted at the manager and said, hey, you guys are set to close only on Tasty Trade. He called him up and got it fixed. And I said, okay, I'm going to go buy it now. And I was, but then I started thinking about it. And for whatever reason, I just listened to a little voice in the back of my head. And I was like, well, this market sucks. This may not be a great time. I already got blocks. I mean, blocks is risky enough. I mean, and I have a lot of blocks. I have 15% blocks. And so I thought, okay, I'm going to wait for it to go lower. I'm so glad. I'm glad you did it too. I'm glad you didn't get it also. But I did get K yield on day one, just like I said I would. But to be fair, it's not like I'm a smart guy or whatever. I would have got ULTI on day one also had it not been set to close only. I mean, because I read the prospectus, and if I like what the prospectus says, lots of times I'll like the company. I made the same mistake with that a fund from YieldMax called FEAT, F-E-A-T. Like what the prospectus said, I bought it, had it 3 or 4 months, and sold it. It was no good. Yeah, I need to get more K yield. No ULTY for me. Yeah, anyone that doesn't like, if you don't like YieldMax, you aren't going to like ULTI either. Now, I know that people like Rex more than YieldMax. That's fine. But I'm saying this particular Rex is built more like a YieldMax. Homeless Zombie was the name on GOW. Okay, well, I was right. It wasn't somebody new, but he was right too. It's an impressive fund. I mean, he kept saying, look at GOW, and I was getting so many comments but I looked at it. It's a great fund. I don't know a good way of explaining that a fund based on a single stock isn't as valuable. I see people say all the time, well, I hate YieldMax, but I'm in Palti. Palti's all right. Palti doesn't have NAV erosion. I mean, or whatever, or Hui or whatever. It just, yes, as long as the stock keeps going up, you're fine. But I would rather be in a portfolio of 30, 50, 100 stocks, Anyway, once it moons, I will add some anchor funds. All right. I want more GUI too, of course. Happy with WPay and QLDY. QLDY has been one of my good calls. I also read the prospectus on that, and I liked it from the get-go of the prospectus, and I bought it close to day one, and I was right on that one. But I was not right on ULTI because I liked what ULTI said. I wasn't right on FEAT, but I get about half of them right. I mean, I like blocks from the get-go, and I think most people would agree that's been a really good one. Anyway, you got to run. Okay, I'll talk to you later, Grumpy. I appreciate that you like the Max Factor, Roxanne. Thank you so much. It's on every night, and then it's on once a week. The weekend show's pre-recorded, where I do a top 20 and stuff, but the nightly show is just for fun, so we can sit around and shoot the breeze. Max Stab Factor. I need income, so I have him. Yeah, absolutely. Absolutely. I'm not being critical, Marcus. You know what I'm saying, but you know too, because I've seen you tell people in the comments, these are you'll say, I think you said it in today's comments. Well, this isn't for growth. If you want growth, just go. I mean, I know you understand the distinction. I hear you. I hear you on that. I'm with you on that. I get that you understand. I just like saying the same thing over and over again. Okay, Alan, what are you up to? And perhaps WOWW. Why haven't I heard of that one? Yeah, they should add a pay W. Oh, a WOW would be, so it's a Round Hill Weekly, but what's the WOW? I mean, I don't know what the underline would be on that. I'm just drawing a blank. World of Warcraft. All I think was here WW's World of Warcraft. I don't know. So it's interesting that ULTY bought leverage bonds. I have not seen that yet. I'll look into that tonight. By the morning show, I'll be able to talk ULTY. They should increase the percentage. Yeah. Does QLDY hold actual QQQs? Let me think. I don't know. And I've done all kinds of reviews and I should know. No, they don't. They don't. And I think that's fine. I think it's better to do it synthetically. But they buy a deep in the money option. A lot of Round Hill funds do that too. XDT and QDT. It frees up money and it moves 1-to-1 with the market. But no, if that's important to you, no, they don't hold the actual Qs. Yeah, I used to follow the trades. That's right. They buy a deep in the money option that expires like a year out. And it moves. If the Qs are up 1%, it's up 1%. The Qs it moves 1-to-1 with the Qs, but yeah, they don't. What makes QLDY, the reason I like it so much doesn't have anything to do with that. It's because to get it, it's the way they get income, the way they do their option overlay. It doesn't impede the upside at all. It adds a little downside, but it doesn't impede the upside at all. So it's like blocks. It gets a ton of upside. It should get roughly the same upside as the market. But all your high yields are, I wasn't giving you a hard, I know you understand that. But so there's income and then there's income, yeah, I get it. And I don't even know how young you are. You may not be that young, but you come across, but I think you're young. You have a young looking picture. So I think of you as being maybe 35. I don't know if that's right, but I mean, that would be my guess. So Shane, QUp doesn't have more than 1 million AUM. Yeah. Do you have QUp? I've never really met anyone that had it, Alan. It's a really interesting fund. But I have some questions on that. In the prospectus, it says they spend 10% of their AUM every day on a net the money option, but you never see them down 10% in a day. And at the money option, any day the market sells off, if you're buying, they buy a 0 DTE at the money. Any day the market sells off, your 0 DTE, which should lose all its value if you're buying a net the money option. Even if the market goes up a little bit, you might lose some value, depending, because you have to overcome the premium. So I don't think that's what they really do. I think they may sell more like 3% or something, but yeah, but it is a shame they don't have more than. It is a shame. It's not liquid enough to look at on a 30-minute chart. That's been a machine. I mean, even with the recent pullback, but on all these days that it pulled back, if they really were writing 10% of their portfolio or selling, they should lose 10% every losing day. They should lose 4.8 points on this day. Let's see if they did. They should lose. Okay, this right here should be 4 points lower, 45 to 48. That is probably 4 points lower. We have sideways, had a big losing day here. Maybe they do 10%. I don't know. But I mean, it doesn't seem to hurt them that much. They're going basically straight up. Look, they came out in March. That's the other thing. They started at 25 and at the worst place they were 20. That's only a 20% drawdown. That's not too bad. It's not too bad at all. There's some of these high yield funds drew down 25% and they're selling calls, which should create a buffer. I mean, yeah, this is a great looking fund. I mean, it's a great looking fund. Thank you for pointing that out, Alan. Yeah, it's a wonder they can pull it off. They're doing some. Maybe they have another something they're doing, another secret. Maybe they have another secret. All right, what else do you guys want to talk about? Trying to think what else we had to talk about. If you guys want to see the diversified darlings, see what they're doing. Because some of you guys weren't here this afternoon. You might like this. We can look at my portfolio. That's not that interesting. The market's not really moving. Let's check out the diversified divas or darlings, whatever you want to call it. I hate when the bar comes up and it won't go away. It does that sometimes. And sometimes it goes away automatically. All right, well. Okay, so we never really drilled down on this. Let's look at week 1. Now, maybe this doesn't work. I never tested it, and I really don't use it anyway. Okay, well, so we aren't going to look at week 1. So these are all the stocks, and we talk about this twice a day on the afternoon show and the morning show. But so out of all these stocks, I really like to follow, and these are the best. My favorite ones are the ones that are in this family. I love ULTY, as you guys know. I like LFGY, although I sold it all at a big profit. I like blocks, and I bought it too high, and I'm holding the bag on that right now. But what are you going to do? Crypto's down. Glad I don't have ULTI, but these are all great funds. KYLD is a great fund. I have some of that. WPay, I have some of that. That's a good fund. Anyway, so it's interesting to see how they hold up. ULTI has so far been the worst in holding up. This goes back since inception since like October 31st when K-Yield and ULTI came out. So the other ones have been out longer, but I started everyone at the same place on October 31st just to see which ones do the best. Anyway, the worst ones for protecting capital are ULTI, blocks, and LFGY, and ALTI, and K-Yield. And then we get down here, WPay, GPTY aren't too bad. Really, K-Yield's not too bad either. I mean, they're still down between 9 and 12% in a week and a half. That's not great either. ULTI is just making these other ones look good. But these have high beta risky stocks in them. They have a lot of crypto. Crypto's down, the market's down. So other things being equal, I guess they're all right. But here's the market right here. The Qs are down 5. So, the best one holding up on the downside is QLDY, the lightning spread fund we were just talking about that doesn't own the Qs, it owns synthetics. Then we have Chippies doing well, GPTY, and you guys seen the rest, WPay, K-Yield, ALTI. All right, but then as far as yield goes, the only reason, a good use case for these is somebody that wants a higher yield, and these are the ones that pay the higher yield, LFGY, WPay, and ULTY. Then these ones down here pay a lower pay. K-Yield is not really a fair comparison, or ULTI, because they've only paid once, where these other ones have paid twice. So, but anyway, and then we can look here at the one-day change. This is what happened today. So LFGY and blocks were the big winners. Everything else was down a little bit. K-Yield was next, and then ULTI trying to redeem itself there, doing a better job. It outperformed ULTY. ULTY outperformed GPTY, SPY, and Qs. That's amazing that ULTY, GPTY, ULTI, K-Yield, LFGY, and blocks beat the SPYs and the Qs today. But over a long enough period of time, you can see the SPYs and the Qs are way ahead. But then the ones that were losing more than the SPYs and the Qs was WPay, QLDY, and Chippy. All right. Then we can look at my portfolio. So here's a graph of it. 18.09% cash, 13% in YQQQ. So that's an inverse, and Salty's an inverse. So 13 plus 6, I have 19% inverse and 18% cash. So, this is heavily hedged, and I've been right about it. I've been right about it so far. I've been right to be cautious because I would have been getting smoked if I hadn't decreased some size in some of these risky ones and hedged. But anyway, K-Yield, 11%, blocks. I need more blocks, and I need more WPay, and I need more QLDY. Then I have BITK from Tuttle Capital. I've been getting smoked on that one too, but it's because I bought it like 2 weeks ago, and crypto's gone straight down. Doesn't have anything to do with BITK. They're doing exactly what they're supposed to do. All right, what do you guys want to talk about? That's all I got for you. Um, all right. What income fund do you think adapts best to the changing market conditions? Well, I don't know. Um, just it's what I always say. Other things being equal, one of the ones that pays the lower amount because that the NAV's the distribution's the enemy here. So that's what causes a depletion. So I mean, definitely, if you're thinking about a changing market condition, stay away from the ones that pay, more than 50%. So I mean, the just the general answer to all of those, which ones are safest or whatever, triple QI. If you can make do with 12%, JEPQ, GPIX, there's a lot of good ones. I would say those probably do the best in a changing market, but it depends on what you mean by changing. If you mean leadership is changing, which happens sometimes, tech starts to massively underperform and consumer discretionaries go back ahead or something, or utilities go ahead because we have a rotation in the market. Well, all of these will suck, even triple QI, because it's based on the Qs. So it depends on what you mean by changing. But if you mean a market is crashing or whatever, the ones with lower yield because they have a lower tax on their NAV, the ones that pay 50 to 80% are still going to pay you 50 to 80%. They won't be able to catch any upside because the market's crashing. So those will be the worst. So stay out of those. But like I say, if you mean a rotational market, probably something like QQA or RSPA, which is an equal weight. That might help you on a rotational market. Won't keep you from losing money, but it might alleviate some of the pain. Quick one, if any of, let's see, existed, well, you mean 2022, I think. And I'm doing a study on that right now. I'm going back to 2022 and I'm trying to project that. But in 2022, the market dropped 30%, and there was some high yield funds that were around back then. I'm doing watch for a video on that. On your question, I don't know. Hard to say. K yield probably. Howard's a survivor. Because he pays a low enough yield. It's only 30%. But on the other ones, yeah, maybe not. Maybe not on the other ones. But I think K yield probably would have made it through. Even if they changed to 50% yield. Well, I don't know. It's hard to say. I'm actually making some content on that. I haven't got anywhere on it, and I've been busy doing these live streams. And then after I get out of here, I need to go check into the ULTI and ULTY trades. Then I'll probably go to bed. So I don't know when that video will come out. Okay, if the SPY, i.e. SPY fell over 10% compared to the last month, for example. Or in 2022, I got you. When the S&P was down, yeah, that's what I was thinking, and the Qs were down 30, yeah. Well, I mean, so we have, JEPQ is a great fund. No one would tell you it's not a great fund. Not only pays 9, 10, 12%, whatever, but it's a very good fund. It has a low expense ratio. It's professionally managed. But I think it did poorly. It has to, because it's based on the Qs. The Qs lost a third of their value. So a fund that tracks it and is paying a yield is gonna catch most of the downside, and then the yield's gone. Because it got paid out to you. Now maybe you reinvested it or whatever, but let's see here. Oh, wait, I still have the wrong stocks in there. JEPQ. And I tell you, I think JEPI might hold up better because because one thing, it's based on the S&P wasn't as down as much as tech. And two, they also look for value stocks in JEPI. They weight their portfolio towards value. So it's going to hold up better as well. Yeah. So sure enough. But JEPQ, just on NAV, went from 50 to 40. That's 20% down on NAV. Now, that's not bad considering the Qs were down 30%. But it wasn't only down 10% in NAV. It's down 10%. Well, now I guess it's down 10% in NAV, or really 12%. And part of that was the dividends coming out. But since they don't pay a huge dividend, it wasn't that big of a deal. Let's actually compare it to the Qs itself towards the end of the year. The Qs were down at the worst 33%, but they rallied by the end of the year. Somewhat. I mean, okay, so by the end of the year, Qs were down 28%. And JEPQ was down 20%. So, covered call funds definitely protect capital, but I mean, it would not have been a fun year to be in JEPQ. You want to talk about erosion? People say JEPQ doesn't have erosion. You want to bet? Well, no, it doesn't really have erosion. None of these really have it, but it doesn't have anything bad happen to the NAV. Like it has stable NAV. Stable NAV's a misnomer. It depends on what the underline's doing. This thing's NAV went from 51 to 40, and it only paid $3.85 in dividends. So, I mean, it's a huge loser for that year. But I mean, of course it is, because the asset it tracks was off, 18%. Why does that say annualized? They didn't come out all the way on January 1st. They were just around from May onwards. So that's also part. But anyway, you guys can see there. Let's look at this. Let's look at, here's another way to look at it. Let's look at QYLD against the Qs. Now this one pays 12%. It's from Global X. And let's run it, from the first day of the year to the last of the year. Now, of course, the Qs were down 33%, and that was through the end of the year. Okay, so you said, I thought they rallied by the end of the year, but no, that was the end of the year number. Okay, well, I kind of suppressed that memory on how bad that year was. Well, I mean, QYLD, they did a decent job, but everyone says QYLD steady or whatever. Well, not this year. It's down 7%, and it just paid a $2 dividend. So all I'm saying is it doesn't matter what happens when your asset's going down. I mean, the only silver lining is you might do better than the asset, and you usually do, because the covered calls create a little bit of a buffer. But it's still not. That was still not a pleasant year to be an investor. If we go back, and some people are saying we're going to go back into a cycle like that, every one of these, even triple QI, every one of these is going to do that. I mean, it's just math. If we lose 30%, it doesn't matter how stable it is. T-SPY, triple QI, the ones I like, GPTY, it doesn't matter. They're all gonna lose money, because remember, these are bullish bets on the market. But yeah, that's a good question. So here's what you can do. Other things being equal, if you just take a lower paying fund, it's less. Let's see. There's one that's QYLG that only pays half as much. But in a down market, it actually may do worse, because the yield is your buffer. This one only pays 6% instead of 12%. Let's just see. This one actually may be worse. But I bet QYLG does better in an up market. Sure enough, it does worse because it sold less options. So it was closer to the options create the buffer. Yeah, look, this one dropped 10 points and just paid $1.53. I mean, people hate Alti and stuff, but I'm just saying Alti's underlying is in a bear market, and Alti pays a huge dividend, so it causes a lot of excess depletion. But I mean, that's the same thing that Alti's going through now. It's dropping more than its yield is making up for. Not just Alti, blocks and a bunch of them. So it looks like QYLD is kind of the best capital protecting one of the ones we've seen so far. And that's kind of interesting. All right, I'll go back to your questions, Alan. Those are good questions. You always have good questions, Alan. You were thinking Big Y. Okay, yeah, Big Y is a good one. T-SPY is a good one. TDAC, yeah, TDAC's a good one. Now remember, it's based on the NASDAQ. If we do it 2022, you see, it doesn't matter how good it is. If the underlying that it tracks is down 33% in a year, and it's something like triple QI that everyone thinks doesn't have any problems with it, well, just think it's going to be down about 12% less, because the dividend, it'll pay a 12% yield, but if it tracks 90% of the downside, so, if the underline's down 30% and you're paying a 12% yield, you're still going to be down 18%. Tuggin's a good one. Tuggin is a really good one. I like it too. Might want to save that image for a NAV loss conversation. Yeah, I'm making some. I have all kinds of other images. I've been doing that all day. working on my 2022 video. Not sure, but add saying the max factor around crashes. Not sure what metrics show that. Not sure, but add saying to the, yeah. The problem is, or I would love to make a crash safety indicator or something. And I could just look at them through 2022 and I could measure how, you know, I could easily make a metric. Most of them have only been around up 6 months. You know, everyone wants me to review HOW and it's been around. It hadn't even been through a crash yet. It's going through one right now. I mean, you know, but I mean, some of these haven't even been around in April. For the ones that have been around a year, we can look at April, which wasn't really a crash, but it was a correction. You know, but it just fee bottomed and came back so fast. Anyone that just held was back in good shape. I mean, you know, so I know what you mean. I would love to add that. I'll think about it. I'm always working on making the max factor better. HCal specifically selects companies with very high free cash flow. Let's see if HCal was around back then. I think it's been around for a while. And what's the other one? CALS, or there's another one. Yeah, no, HCal wasn't around back then. Isn't there one called CALS or something? But they just weren't around in 2022. Well, what about Devo or iDevo? Or what about Devo? Was it around in 20? Yeah. Okay, now look. Now that's a good look for Devo. That is a good look for Devo. Look at that. I mean, now I don't know that it's fair to make the Qs its parent. It's probably more fair to make the SPY its parent. But let's compare it to the SPY over the same time frame. Okay, well, SPYs were down 18, yeah. So the thing with Devo, though, it pays a tiny yield, right? So the tiny yield hurts it on the downside because it gives it less buffer, but it doesn't impede it as much on the upside. So, but still, I mean, it went from 38 to 35 and only got $1.71. So it's still a losing bet, but it did better than lots of other ones. But to see my point, if the market's going to do that, they're all going to, I mean, all of these are dependent on the market. I think to a lot bigger extent than people realize. I think a lot of people think there's something special about these funds, and some companies have erosion and some don't, but no, they're all just selling covered calls. It's not as much dependent on the company. It's dependent on what the underlying is. But yes, the companies that pay a higher yield, you know, they'll have more risk for sure. There's CALS too. Okay, QDevo. Let's look at QDevo over that same time. Oh yeah, QDevo is the Qs, of course. We can compare it to the Qs. But yeah, that's a good look for QDevo. And it wasn't out yet. It wasn't out yet in 2022. But this is basically the video I'm going to make. I'm making a video where I show all this stuff. I do that all the time, where I workshop the idea with you guys. And then I'll go ahead and make a video and record it for everyone else. What is going on here? That's kind of cool, isn't it? That's really cool. Let me shut this window and then open this window. All right. Bank account bonus centrals here. What are you up to, bud? Appreciate you showing up. We're just getting ready. I'm getting ready to make an excuse and get out of here. I am dog ass tired. I mean, I'm exhausted for some reason. God, I hate how it switches styles on me. I like this style. Wonder what show headlines means. Oh, I could yeah, I see. I could put a title on there, like CEO of the Max Factor or whatever. All right. But anyway, remember, this isn't, I'll answer questions. If there's more questions when I go back, I'll look at them, but I want to remember to read the disclaimer. Remember, it's not financial advice. It's always a good idea to consult somebody who has a license, somebody who's a professional, does this for a living. The most important thing is that he has a relationship with you and he knows about your situation. He knows what tax bracket you're in. He knows if your wife has a job or not. He knows if you have a trust fund or not. I don't know any of this stuff, so consult a professional. You get personalized. I'm just trying to give general. I'm telling you my thoughts on it. I'm giving you good advice for me, but it's probably is lousy advice for you. So what else? And also don't forget, you can support the Max Factor. I always appreciate that at paypal.me/Max Convexity. You can buy me a coffee there. It's not a buy me a coffee link, but whatever. And anyway, like I said, I'd be happy to answer questions. I want to answer. Okay, I'll start with this one. Okay, 703 or RJC. Anyone ever track CLM or CRF? Yes. We do it all the time on the Max Factor. In fact, we had a special show last Saturday night, I think, called Closed, or maybe Friday night, called Closed In Fun Friday Night. And we lined up 20 of these things, and I did my Max Factor show. We looked at everything. We looked at the yield. We looked at the price 90 days ago, the price now. We looked at so that means the quarterly NAV return. And then we looked at how risky they were, and the Max Factor synthesizes it all, and we declared a winner. Or the Max Factor did. What was the winner? Was it one of the Roundhill ones? I forgot which one it was, but Roundhill did very well. Yes, it tracks very well with these. It tracks very well. But now, speaking of Roundhill, let's see how they do during the crash. I mean, they were around in 2022. Let's see how well they protect capital. Let's see. I bet they don't do as good of a job as that Devo. Devo did a wonderful job. That was a great look for Devo. But let's just run Devo in 20. Let's go back to 2022. I shut the window, I guess. Let's go back to 2022. And let's do January to December 31st. We'll do CLN. Excuse me. Let's track it to Devo. That Devo was impressive. Yeah. So CLM, it's not crash proof or anything. I mean, heck, it was down 34%. And it's not, there's nothing wrong with that. It's a 4-star. It's one of the best funds or whatever. But in that case, none of them work. That's the other thing, is none of them work in every circumstance. I bet Devo looked great in over this time frame, but I bet we could go find another time frame where Devo seriously underperformed and just got spanked probably by CLM in a different type of market. They all have different strategies and stuff. CLM is a good fund, but it didn't do really well. That's really, I mean, it looks like it lost as much as the NASDAQ. You want to talk about depletion, it dropped from 14 to 7 and paid $2. I mean, that's worse than ULTY is doing right now. I mean, ULTY is staying closer to it, is paying at least close to what it's dropping. But I mean, that's a rough one. That is a rough one, but over the course of time. But so we always have to look at both sides here. Let's go back to 2013. And let's run CLM against the Qs. Yeah, it's pretty good. Pretty good. It's only averaged 4% a year. That's actually not too good. If you reinvest dividends, and I know they have rights offerings, this doesn't factor in the rights offering, but if you reinvest dividends, which kind of defeats the purpose of yield, whatever, but you're up 11%. But actually CLM, it looks like a pretty big underperformer. Now, let's see if a covered call fund can beat it, though. Covered call funds underperform too, but I bet they don't underperform as well as that does. I mean, as poorly as, let's look at QYLD over there, because I think it came out in 2013 or 2014. Yeah, it came out in 2013. QYLD beat it, but they both didn't do very well. CLM got 3% a year. 4% a year. That's serious underperformance compared to the SPY, just holding the SPY. Yeah, and you get an income or whatever, but QYLD wasn't much better. It got about 5% a year. It's just it's a covered call fund. They sell at the money calls on the Qs, and it has a seriously capped upside. And no one likes this fund, but the reason I chose it was because it's old enough to look at. Okay, so Alti added GDX, GLD, and TMF. Thank you very much. I'm going to go look at it as soon as I get off of here, and I'll talk about it in the morning. So you said the other night the GOF would fall under 12, and were you right? Did it? I wonder if GOF was. Let's look back on this old thing. Let's see. Isn't some of these closed-end funds have been around a long time? Let's see. Let's run GOF and CLN together. Yeah, they've been around. So, I mean, dividends not reinvested. They're very close. I mean, 4.6, 4.9. They're very close. They had tons of NAV depletion. CLM went from 24 to $8, but it paid a $35. It paid a $35 yield. So more, I mean, dividends collected, so more than made up for it. Yeah. You closed at 11.97. Well, good call, Michael. Good call. You have YYY too. YYY tested pretty well in the other night. We'll probably have the closed-end fund competition again on the Max Factor. So keep watching it every night. Be watching for that. That'll probably be a regular feature. I think we did it either last Friday or Saturday. I forget what we do on Wednesdays. It's just kind of whatever I feel like. Probably, I'd really like to do Bitcoin ones once a week because there's a bunch of them and they're fun to compare. XBTY to BCCC to XBTC to YBTC to YBIT. There's a ton of them. So maybe we'll do Bitcoin Wednesdays, something like that. GOF fell to $8 before that, I think, in 2020, and it could repeat again. Yeah. I hear you. Well, we have a pretty good crowd here tonight. Okay, if there's any other questions, I'd be happy to stay around and answer them. I'm just getting kind of tired. I feel like I've been talking all day. All right, let's try that. BDCS against BIZD. BDCS, okay. Business Development Corporations. I mean, but it's a ticker. All right, BDCS. All right, sorry. BDCS against, I already forgot. I'm sorry. Or getting hosed with that private crowd stuff. Yeah. Yeah, I've heard UTG is a good fund, a good CEF. Okay, BDCS against BIZD, Business Development. I got you. BIZD. Well, they've been around a long time, but one of them closed in 2020, I think, because it stopped in 2020, and I asked it to go all the way through 2025. Yeah, I mean, that's not a great look for BDCS. It's a decent look for BIZD, but 4% a year when the market gets, the market averages 9, 10, something like that. So you're underperforming by a lot in any of these closed-end funds we look at so far. But the same thing with covered call funds, and it's the same thing because they pay an income. Anytime you pay an income, it's like having to support something. It's something extra that a fund that's just a growth fund doesn't pay an income. So it doesn't have an extra thing to support. Like I say, the income is the solution and the problem at the same time. The call's coming from inside the house. There's nothing special about some of these funds. I mean, there just isn't. It's just that they all pay an income. So they're all going to varying degrees, though. That's what the Max Factor tries to identify. Some do it, some do worse things than others. But so YYY has been around since 2013, but BDCS got delisted, it looks like. So let's do YYY against CLM because we know that's been around the whole time. Yeah, that's a bad look for YYY. I mean, over time. I mean, look at that. You're only getting 2%. You're barely keeping up with inflation in YYY. People talk about closed-end funds like they don't have erosion and whatever, but who knows? But I mean, based on the ones that we're running here, they also seriously underperform. But to be fair, the covered call funds we've run have underperformed also. So I mean, it's kind of like I say, it's because they pay an income. Here's another one. Let's drop YYY because it didn't do very well. At least not over this long period of time. I'm sure there's periods of time where it's done great. I'm not saying it doesn't have any use or whatever, but over a long period of time, it's barely keeping up with inflation. Let's do CLM against, there's another fund that's a covered call fund that's been out forever called First Trust, FTHI, First Trust High Income. Yeah, it came out in 2014, and it's spanking CLM. Gets more upside. It's probably more risky too, but it's compounded its money at about 5% per year. Still underperforming, just buy and hold. But the NAV actually went up over this period of time, went up $3, and you got $14 in divvies, where CLM's NAV went down. I know CLM's a different deal because of the rights offering and stuff. Yeah, FTHI, that's a good look for FTHI. There's another one that's been around for a long time, another covered call fund from Nuveen called QQX. Look at that. That's the best covered call fund as far as going back a long time that we've tested yet. That actually almost keeps up with the market. Not really, because it's based on the Qs, and the Qs probably average about 12% a year, 15% a year over the same time. But I mean, it does better than, any of the closed-end funds over that long period of time. The NAV went from 17 to 27, so up $10, and you got $19 in divvies. I just prefer covered calls. I mean, I just think that's the best strategy. Because covered calls, even though they aren't perfect and they have issues, but they're repeatable. There's some of these funds like XPay that just sell stock, and I just don't like that idea, even though that does all right. The just selling stock idea, if you do that and you live a long time, you might run out of stock. But if you could find some good covered call funds, they should be able to regenerate forever. They aren't going to do well during a bear market. We looked at 2022. But nothing's going to do well. So let's look how well QQX did, that fund from Nuveen, in a bear market. What were we comparing it to? Let's compare it to, I forget what the best looking one was in the bear market. We'll just compare it to the Qs. We'll see if it did better than the Qs, or it had a great long-term record. Of course, it underperformed. Well, this is, hang on. Let's look at the Nuveen fund in a bear market. Down 27%. And it's a great fund. You can see it made 8% a year over 16 years or 12 years. It had positive NAV, tons of dividends. But if you would have bought it here, you would have thought it sucked. There's different, it's a victim of the market. All right. So yeah, YYY is a fund of funds that includes 60 ETFs. Its long-term performance didn't look that good, did it? Let's see. Compared to some of the other ones. GEMI is a pinch play, means oversold. That has, I used to know that pinch play setup. I forgot. I used to follow that. That's from old Simpler Trading, isn't it? Don't they believe in that pin? I used to even have a somewhere that I used to look at that. But anyway, I got you. I got you on that. Jimmy's a pinch play, means oversold. The has upside of 16.5. Yeah, heck yeah. Jimmy. I was telling the group last night that major support's at 89,000, and I may not have seen that message, but I appreciate you for reminding us. A rebound of these ETFs could bounce now. Yeah, and I've been saying they should bounce at 90. But I'm also saying if it gets under 90, probably going to 75. But yeah, I think it should bounce too. Let's go look and see what it's doing right now at this hour of the day. We'll check out a little Bitcoin futures this time. 92. Well, actually, let's do it this way though, because I drew this several days ago. I didn't just. It's not that I'm have any special knowledge, but there's a huge gap right there. I forget what happened. That was a news event, April 22nd. But anyway, it gapped through there, and I theorized there might be buyers here. So far, there has been. But still, even we just have so much damage. Even if even if we get a 2 or 3 day rally and we go up to this point, I mean, it's probably a sell. I mean, and even if we get back to the trend line, we could fell there and that could be a sell, just like that just said this has all the hallmarks of a terrible market. This reminds me of April or last August. Now, it won't last forever. At some point, it'll rally, but I'm just saying there's been a lot of damage done. I mean, there's been a lot of damage done just from a technical perspective. But yes, if it could hold this low, maybe build a base and it just won't happen in one day, but that would help. That would definitely help. SOLT, Ether, Solarium or Solano and Ether. Yeah. BTC is always down this time of night. I was just talking about how it's been down for 2 or 3 weeks, but yeah, I wasn't even looking at this time of night. I think that was a daily chart, or was that that's a daily chart, but yeah, no, hopefully it'll rally. Here we can look at it's actually off the lows. It's actually, it's off the lows that were made, at 1 or 3 o'clock or whatever. So heck yeah, we just have to take back this moving average one thing at a time. That's the first thing to take back. The next thing to take back is the 95 area where you have this prior point of control. And then you have to hope you don't get overwhelmed by sellers, people trying to sell the rip right there and run it back down into here. But then if we get past there, then this yellow line would be important because this is where the breakdown occurred. So that would be step 3. We just have a lot of technical damage on the chart, but that'd be wonderful if that started happening because it would really help out the funds I have. It would help out Alt-Y, it would help out blocks, it would help out K-Yield. I mean, K-Yield's down 9% in 12 days or something. I mean, yeah, it's doing decent, but I mean, it could definitely get some help from the bull market. Mr.'s buying all probably so. What's up with Hood? It's been going down like a rock. Well, it's correlated to Hood is Robinhood, right? So Robinhood, I mean, aren't they basically a crypto brokerage? I mean, they're stock too. It's stock in crypto. But I mean, I would imagine it's pretty correlated to crypto. Anything crypto's been bad lately. Imagine someone had a line of credit secured Bitcoin with 70% advance rate. Yeah. Bitcoin's a little red. Perhaps people are scared. They need to understand it's a buy. Heck yeah. Charts Bitcoin could rally. I would love to see the 102 and 102,000 is the 20-day moving average. It could do it too. If anything could do it, it's Bitcoin. And just think I don't really care so much about Bitcoin, just what it would do to blocks and some of the other funds I have. But if it went back to 102, blocks would be raging. It would be absolutely killing it. All right, guys, so I'm tired. I'm going to get out of here. Like I say, remember, you can always support the channel. And don't forget, it's not financial advice. Consult a professional advisor. I'll be back in the morning. I really do have to go look at those ULTI and ULTY trades. I want to see what the heck's going on. And I'll be back in the morning, all right? I appreciate you guys being here. I hope you have a good night. Crypto is more tied to certain generations like Gen Z and millennials. Yeah, all my friends who are millennials are heavily invested in it. Meme coins, everything. So yeah, it is. It is for sure. And and who runs Silicon Valley is Gen Xers, people my age, like Peter Thiel. He may be 10 years younger than me, but Elon's in his 50s. Silicon Valley is run by people my age, Xers. So yeah. All right, guys, you have a great night and I will talk to you later. Thank you so much.